Hello and welcome back to a new episode of the CTO Show with Mehmet. Today, I'm very pleased joining me from the US, from Boston, Isabelle Tashima. She is an investor in Volition Capital. Isabel, I don't like to steal much of my guest time when I do the intros. I have a very simple introduction. I just give a teaser to the audience. Of course, as you can guess from, what Isabel, where she's working, we're gonna talk about investments, of course, and we're gonna discuss like a little bit about what she's seeing currently when it comes to AI. And we're gonna talk about like maybe due diligence a little bit. We're gonna talk about like how Isabel look at growth companies, and we will see how the flow will bring us to this discussion. So without further ado, again, welcome Isabel to the show. The floor is yours. So tell us a little more about you, your journey, your background, and then we can start from there.
Yeah, thanks so much for having me. Excited to be here. A little bit of background on me. I'm an investor at Volition Capital. We are a Boston-based growth equity firm. I grew up outside of Chicago. I was a competitive athlete growing up through college as well. And I think that shaped a lot of how I approach work. And so I started my career at Goldman on the middle market M&A team in New York following my undergrad. Which I think gave me a strong foundation in terms of understanding how capital markets work. I worked with some founder-owned companies there, which was a great experience. But I think through that, I realized, hey, like I want to be a part of their experience for longer. And I think some of the most interesting kind of like experiences that you can see from a founder perspective actually occurs prior to an exit, not just at the end when there's a transaction. So then I went and did my MBA at MIT Sloan. And when I was there, one of the managing partners at Volition was actually a guest speaker in one of my classes. And he talked a little bit about one of the investments we made in the company Chewy and how he thought about that and the firm's approach. And it really resonated with me. So I joined Volition about 2 years ago out of business school, and I sit on our internet and consumer team.
Great. And thank you again, Isabel, for being here with me today. I'm going to start kind of where you left. I know there is a lot of maybe some misunderstanding from everyone, but let's talk about founders. About when it comes to an investment firm like Volition, and you say you are you focus on growth, um, uh, you know, I would say stage, right? And I looked at the website, and there's a lot of talk there about the capital efficiency. So when we talk about a company being capital efficient, in simple terms, how do you define this?
Yeah. So I think at the highest level, what we look to do is partner with founders that have done a lot with a little. So a lot of the companies that we partner with have gotten to where they've gotten to. And usually we're looking at companies in the 5 to 50 million of ARR range. They've done it with minimal to no outside capital. And so that signals to us, hey, this founder is disciplined. They have a product that customers love, not just because they're buying the growth, but because the business is built on strong fundamentals and they have a product or offering that's solving a real problem. So that's how we think about capital efficiency at the highest level. And then we usually come in with a check anywhere between 15 and 60 million to help accelerate what's already working. And so that's kind of how we partner with founders and how we think about capital efficiency.
Great. Now, from your perspective, Isabel, like when do you think, or let me put it this way. So I talk a lot with founders. I work with them as well. And, let's put it, straightforward. And I think some people will agree with me. Like usually if they are in the funding mode, so we're going to go everywhere, right? So, and sometimes they mix up the VCs with a growth equity, like where you work today with private equity or as sorted as PEs. So at what moment you consider a founder should stop, let's say, hey, like you just you gave a hint, but I want to deep dive more in that. Where they should be stop actually raising from a VC and maybe start thinking about the growth equity.
Yeah, I think it's a fundamentally different model. And so growth equity tends to sit kind of in the middle. If you have early stage venture on one end, and then you have kind of traditional buyout private equity on the other end, growth equity is really in the middle of that. So if you think about an early stage venture firm, they might invest in 50 companies, and it's more of a diversification play where they're investing in a bunch of companies and they're hoping that maybe one or two do super well and return the fund. And then on the back end of that, on the private equity side, they are investing in more mature businesses, slightly slower growing. There's some level of financial engineering involved, and often they use debt in that case. And growth equity sits in the middle where we build a concentrated portfolio of companies. So we treat each company like a portfolio of one. And we try to be a very active partner as part of that investment. So we're not investing in 50 companies with limited evidence of product market fit. We're investing in more mature businesses that have proven they have a product that works. They have proven that they're solving a gap in the market and they're trying to get from A to B a little bit faster with the help of a growth equity partner to take them from 5 million of ARR to 200 million of ARR. So it looks very different than taking a company from 0 to 1. It also looks very different than taking a company from 20 to 30. So we kind of sit in the middle there, but I think the impact that we have is often extremely valuable because the processes that a company has in place to get them off the ground are often not the same processes that work to scale them up.
Right. Now, if I want to put this, because I educated myself more on the VC side of the business. So if I want to compare this, so I would imagine what a company would look like. They are a pre-series A or maybe post-series A, right? And then they want to jump to the series C, series D kind at a quicker pace, because usually, and this is something like it takes time, right? So even when you get the money, you still need to build your GTM strategy. You need to build that. So I'm trying to like understand this more from you. Is that a right explanation? Like the post series A probably to series C or D?
Yeah, we typically come in at the Series A, Series B stage, and the whole time for us is flexible. So we'll partner with companies anywhere from 5 years to upwards of 10 years. So it really is a longer term strategy for us, and that might span north of a Series D as well. So it's an interesting space to play in because we get to really see companies grow and evolve and scale. So that's right. That's typically kind of where we come in at the Series A, Series B stage.
Right. Like any other investor, whether you are like a VC or PE or like growth equity, you must do some due diligence. And of course, like you would be looking for some signals. So when we look at a company doing, let's say, between 5 to 20 million ARR, like annual recurring revenue, what do you think separates the ones who are, can become, as we call them, category movers, or, can become leaders in that space, from those who, yeah, they have the revenue, but, they have reached a plateau and, they couldn't, cross to the next level?
Definitely. It's a good question. And it's kind of where we spend a lot of the time when we look under the hood of a company that we find interesting. I think the first question for us is always, are they solving a real problem? And do they have customers that love them? I think that is often a good signal of whether the traction that they've had to date is going to continue moving forward. And then from there, it's about understanding how they built the business on a foundational level. So looking at things like unit economics and customer behavior. So understanding, hey, are your customers sticking around? What does your sales motion look like? And are these things repeatable? Because how we think about an investment is our capital shouldn't be going to fix things that aren't working. It should be going to accelerate something that's already working. And so we want to feel like there's repeatability in that, and that the company has really found a seam in the market that is durable longer term.
Right. Now let's talk a little bit about the team also, the founders, right? So do like usually I know, like mainly in pre-seed and seed phase, we put a lot of, attention on the founders, but I think, at that, when they are like kind of series A and above, so we know like the team can deliver, but we look at certain metrics probably. Do you see, also founders still like over optimize some of these metrics, even when they have reached that phase. So they are kind of still in that, I would call it this um, mentality or mindset, let's call it, like as if they were still in the pre-seed or seed stage, and still they try to optimize things to make things shiny. So what are like the real metrics, Isabel? Like, of course, like the ARR is the most obvious one, but are there like any other ones that you look at? And what do you think they sometimes, some of the founders, they do mistake where they mention things which might affect actually the discount during evaluation?
Yeah, I mean, I think it's a good question. And I would say the founders are still very important as part of our investment decision. And the way that we think about it is we don't need a founder to show up and tell us this perfect story of, hey, my company is perfect. There's nothing that we need help with. All the metrics are perfect. That's not really the story that we're often looking for or investing in. I think it's more important to be clear and concise with the story. I would say like the strongest founders are ones that can articulate what's working, where the business is still evolving, where they think they could use outside help. And that sets up the foundation early to have, an open conversation on both sides and figure out where we as partners coming in can be most useful. So at the highest level, like we're looking for things like, as you mentioned, evidence of product market fit, which we think about as, typically companies in the 5 to 50 million of ARR range. We're looking for growing companies. We're looking for capital efficient businesses that have gotten to the scale that they've gotten to without raising tons of outside capital and buying the growth. And then we're looking for repeatable unit economics. So are your customers sticking around? Is payback efficient? What does it cost to acquire a customer and how has that trended over time? But we're not looking for founders to show up and tell this perfect story, because oftentimes that's not what it really looks like under the hood. And so I think the more that founders can be clear and concise about, hey, here's what's working, this is where we're going to put the capital, and this is where we're still struggling and continuing to evolve the business. Because the reality is, like, early on, going from 0 to 1, the founder is doing a lot of the work. It's often founder-led sales. It's often sub 10 employees. They're touching every part of the business. But that's
Right.
not a scalable motion to go from 5 to 500 million of revenue. And so that requires processes and structure to be put in place. And the founder's no longer going to be able to touch everything. And so I think a founder that is able to recognize and be self-aware about where they could use help, where they could use processes and structure, that makes it easier on our end to come in and feel like we can provide help to the founder as well.
Right. Now, of course, in order first to achieve, these results before they reach out to you, Isabel, like they should have implemented kind of a strategy for go-to-market, right? And, the goal here is to double down on what have worked for them, so to go to the next level. Now, um and I know like there are like slight differences between like consumer businesses, which I think you focus more, versus like B2B, which I know like your company also they do that. But in general, there are like, the distribution is key. So how much important are you seeing also the distribution in the current, market landscape becoming more important? And are you seeing, I know it's a little bit, and sorry for doing this, little bit of stuffed question. um how much also it's becoming important for the founders to be leading also this go-to-market strategy? So mainly we call it like sometimes founder-led GTM. What are you noticing from the successful companies that you have worked with or you're working with currently when it comes to GTM and distribution?
Yeah, I think it's a great question because distribution is essential. You can have an amazing product, you can be solving a clear problem, but if you can't get it out there and you can't sell it, and nobody knows about it, then it's hard to be successful. So ultimately, distribution is key. So we think a lot about distribution. Obviously, differs B2B or B2C. I'd say like on the more consumer-facing side, what we often want to see is that there's some level of organic growth coming from word of mouth, coming from referral, because that's often evidence that there's organic traction because your product is solving a customer pain point, not just because you're buying tons of ads and kind of buying your growth that way. So I'd say that's one thing that we look for on the distribution side for a consumer business. And then on the B2B side, often it does start with founder-led sales. And that's very common at the early stage. I think it can be helpful for us to see, hey, this company's hired a few sales reps. This is what the productivity ramp has looked like. And they've done it a few times to the point where we feel confident that if we put more capital into growing the sales team and the go-to-market org, it's a repeatable playbook, and we know what that will look like. So I think there's a fine line between companies that have super scrappy founders, they're doing everything, and they've achieved growth that way with very little outside capital, and that can be great. But it can also be helpful on the investor side to see a company that's already started building out that org to understand, hey, this is repeatable and we should put fuel on the fire.
Right. Now, I got to ask you a question, Isabel. It's more about, okay, we have the capital, but also we need to take care of the efficiency of using this capital. Now, I'm not an expert in B2C, to be very frank with you, but, a couple of months ago, I read the book called Cold Start Problem, right? And my takeaway from the book, and of course, I will remember the author name, and sorry for that. Like, he used to work at Uber. So when we look at companies that reach this very, fast growth in short time, we see like they had to burn cash like crazy. And of course, but at the same time, it fits the thesis of, as you mentioned, this organic growth. So it was kind of an organic growth. Of course, they run ad, they run campaign. So if we look at companies who are, I'm not say similar to Uber, but let's say they have great potential and they need the capital, how much do you think, the trade-off is acceptable between, this fast growth and efficiency? Or are we living in times where the pendulum completely now shifted and, doesn't matter, like grow, as we used to say before, like grow at any price, at any cost? So what's your take on this?
It's a good question. I think it depends on the type of business model. So especially on the consumer side, there's companies, especially in the social space, social network space, companies that rely on network effects where maybe they're spending a lot to acquire users and they're not yet monetizing them. And so it appears like they're burning a lot of cash. But I think it's kind of like an art rather than a science when you look at those types of businesses, because you could argue that the user base and the data moat around it is worth it. And then there could be a flip of the switch and you start monetizing them and the business then looks very different from a burn profile perspective. So I think it definitely depends on the type of business, and there's different strategies around what you're optimizing for in terms of, are you optimizing for acquiring users or are you trying to monetize them while you do it? And so I think like this concept of growth at all costs, which used to be kind of the norm, has definitely shifted, especially as AI is making companies more and more capital efficient. And for us as investors that is always focused on capital efficiency, I think it's exciting because it's opening up the market to see companies be more and more capital efficient. And so I think our view is like we prioritize and tend to partner with companies that have been capital efficient the whole time. Like they've built their business in a way that allows them to control their own destiny. So it doesn't rely on the capital markets to continue to fund the business. It puts them in a position where they can choose to go out to the capital markets to raise capital and accelerate what's working, but they're able to control their own destiny in that way. And I think that that's optionality that becomes invaluable when ultimately, inevitably, hype cycles shift.
Mentioning AI, speaking about AI is on everyone's mind. And, if I want to look at, your space, Isabel, like I'm sure it's like any other industry is reshaping the full thing. So from your seat, where do you think AI is actually creating real value versus just, it's the narrative like, yeah, we have AI?
it's definitely a reality right now. I feel like almost every company is calling themselves either AI enabled or AI native, and it's for sure a buzzword. I think there's a couple ways to think about it. First, I think you have to ask the question, is AI actually improving the unit economics of the business, not just layering on top of the product? So is it lowering CAC? Is it raising retention? Is it raising gross margin? Is it allowing you to use, a smaller set of people to deliver the same outcome? That's when you start to get the sense of, okay, maybe it's structurally changing the business. But if the financial profile of the business looks the same before and after implementing AI, then maybe it's more cosmetic than the founder is saying it is. Second, I think we try to think about, okay, is the data proprietary? So I think defensible AI applications have a data moat where a competitor can't come in and do the same thing because the data that they're using and feeding into the AI is actually proprietary. And that helps from a durability perspective as well. And then I think like the last thing that we're trying to think about, which I'm sure is on every investor's mind right now, is like, what is replaceable and what can you recreate with AI tools that are advancing very fast? So that's a question that we didn't used to have to ask is, okay, could somebody go out and recreate this exact same business, with 2 people? And that's becoming more and more real as some of these models are advancing fast. And so I think all of those things together, we try to look at holistically to determine, is there a moat around how this company is using AI, or is it purely kind of a wrapper that appears more cosmetic to inflate multiples?
Now, on this, Isabel, and this is my own, I would say, 2 cents kind of opinion on the matter. So, because I couldn't, neither as someone who work in tech or as someone with, let's say, an investment lenses, I couldn't yet decide on this. Why? So, because I have some contradictions in my mind. For sure, the mode is not anymore what features you have in your product. So we know this. Like you can just go and vibe code this feature in any of the tools in no time. So some people, as you said, like maybe the data, the proprietary data is kind of a mode. But we started to see now that even like sometimes startups or companies, they have proprietary data, but they're not reaching the next phase. The reason is back to the growth motion, the distribution. So some people they go and say it's the distribution which is your moat now. Like how big is your network, right? So you mentioned like a couple of minutes ago about the organic growth. So your organic growth becomes your actually defensible moat, right? So defensible against what other startups who might take the same thing. And people give the example again of you know entering a crowded market. Let's say people give the example of Google all the time. Like there were like tens and maybe I don't know maybe more of search engines, and Google went in and they were able to show the difference, right? And we can take a lot of other examples. So do you think that now it's combination of all things that we just mentioned, or it's really again back to the data only, or it's like because by the way, and also one thing I noticed, I've seen some of these rappers startup, they're doing very well, right? So
Yeah.
so they have. I would just mention, and this is maybe will shock some people. Every company that offer the vibe coding, they are actually rappers if you want to think about it, because they sit on top an LLM. It's not their own models. So I can argue that a company like Replit, for example, or others which are like similar to Replit, they are actually rappers. Of course, they had infrastructure before. But I can argue this way. What do you think, Isabel? Like, am I kind of philosophical here, or what's your take?
Totally. I think businesses that are rappers can still be giant businesses, but it's not because they're a rapper that they become giant businesses. There has to be some other element there. So to your point, it's companies with some sort of distribution advantage, whether it's channel partners, whether it's they have some sort of like embedded distribution that's allowing them to scale faster. That could be a reason why. I think something else that we're seeing, especially on the consumer side, is companies that might just be a pure wrapper, but they have some sort of community element. They have some sort of brand halo. They have some sort of network effects that's keeping people there, despite there being alternatives. Or, they could build this themselves. They choose to stay with this other company that's might be purely a wrapper. Partially because of that community brand, the network effects, like those elements are very powerful. And so I think you can't underestimate a company that's simply a wrapper if there's other elements at play that are keeping people around.
Right. Um, Now I'm gonna go back to the founders. And of course, maybe few people they know when any kind of investment company or firm they do an investment, it's a partnership at the end of the day, right? Because it's not just you put the money and then you sit aside and then you wait what happened. Now, in your opinion, what makes a founder easy to back at this growth stage, which you focus on, versus someone who you would say, like, let's say if I recommend you someone, you would tell me, Mehmet, never bring someone like this person again. Like, what would be like these two kinds of personas, I would say, for being, I would say, investable and backable.
I think focus and self-awareness are very important as founders. I think the strongest teams and the strongest founders, they know what they're good at and they're comfortable with saying what they're not good at. And they're able to attract really strong talent to fill in those gaps. Another quality that I think is consistent across some of our best founders is that they are completely customer obsessed. Like they're not just focused on growing the metrics of the business optically, they're focused on the customer experience. And if that means they're growing a little bit slower to scale thoughtfully on the customer experience side, like we view that as a strength from a founder perspective. And so I think like the best founders are doing a combination of surrounding themselves with great people, being focused and being self-aware, and then being totally customer obsessed. So I think those are all very important and often shared themes when I think about some of the best founders we've partnered with.
Right. I know, Isabel, you talk about, which is kind of we covered that, but I'm gonna ask it in a different way. So you talk about, a formula which can do the 5x outcome, right? Which is the
Mhm.
capital efficiency and the growth. Like any of these, do you think it's coachable? Like, do you think like someone might come and when you partner with them, you would be able to coach them to reach exactly the criteria that usually you would have as requirements to invest in. What I'm trying to say, like, do you sometimes say, okay, maybe they're missing on this, but we think like the team can be coachable, like we can still partner with them because you know maybe they don't have experience scaling companies to that level before. And this is maybe applies, correct me if I'm wrong, to first time founders, maybe
Definitely.
that crack the code, but they get stuck. So what are like some of the things that you say, okay, we can not ignore, but we can, yeah, like we can wait for them to learn it, but let's, regardless, partner with them.
Definitely. We aren't just solving for a specific checklist of has to have experience in the sector or has to have a successful previous outcome. Like we aren't trying to check boxes around that. All of our founders look totally different. At the end of the day, I think we're just trying to understand like, will this be a collective partnership together? Like, will we be able to add value? Does the founder want our help as well? Because it's a two-way relationship. We want to help and add to the business in any way that we can through the whole period. And we also just want to support the founder in what they're already doing. Like we're not trying to come in and change a bunch of things about the business. We're choosing to partner with the founder and the business because we love what they're already doing. So I think for us, it's about the relationship. It's about understanding, does the founder want and appreciate what we can bring to the table in terms of value add? And what does that relationship look like for the long term? Because this isn't just a 1 or 2 year relationship. This is sometimes a 5 to 10 year relationship. And so
Right.
we want to feel like the foundation is there to have a successful partnership. I think that's probably the most important above all.
Right. Um, so, like any other investor, I believe, Isabel, like, you have to prepare your memo, right? So you need to, when you do your evaluation, how much AI, went into this and changed the way how investors prepare their final, recommendations when it comes to if we're gonna invest in a company or not.
It's changing very rapidly. In some ways, I think it's making our job a little bit easier because we can now get up to speed on companies, get up to speed on markets, better understand risks that may have historically been blind spots a lot quicker. So in that way, it's speeding up things that could have taken 2 days to make and 2 days to research, and we're doing it in 2 hours. So in that way, it's pretty amazing. I think on the other hand, there are some ways in which I think it's making it our job as investors a little bit harder because patterns and metrics that we used to look at, like, is net revenue retention strong? Is gross margin high? Like, what is payback? Okay, if those metrics are strong, that's probably good evidence of a strong SaaS business. Like, that's kind of how, at the highest level, you could think about it. And now those aren't necessarily signs of a durable business. And so, as investors, the diligence questions that we're asking haven't really changed, but I think the answers now have a lot more variance, and that requires a lot more discussion internally about some risks that we didn't used to have to discuss. Especially as the market's changing so fast, it's introducing a whole new set of unknowns that we're spending more time on internally. So I think in some ways, it's making our job both easier and harder.
And decision faster, I would say.
Getting to decisions faster.
Yeah.
I think it's getting us the information faster. But at the
Hmm.
end of the day, investing is still a people business. We are
Right.
partnering with founders, and that relationship is still very important to us. And it's getting us the information faster to make a decision. But there's still, I would say, on the back end, a lot more questions that we're having to answer now than we didn't used to have to. And so it's kind of a balance. I'd say maybe a little bit faster, but because there's new factors involved and things that we didn't used to have to think about, we're probably spending more time discussing on the back end.
Which I think, what I tell people about is like not only investment, it's like also, let's say, sales, right? So anything that requires this human interaction and building the trust and building the
Mhm.
relationship. So you need to be patient on this. Like AI can, can make everything faster, except I think, the trust and the relationship building,
Yes.
because this is needs time. And, like even if you come with the perfect, business proposal, your data room is clean, still. And this is, I think it's a human nature because if someone comes to me and everything looks perfect, might say, hey, this is good. This is so good to be true, right? So I need to spend time with this founder to make sure, like we can work together. We will not have clashes in the future. Like they kind of understand my culture. I understand their way of thinking and all this stuff. So I agree with you on this. Now,
Definitely. I think we see,
continuing, yeah, please.
no, just on that point quickly, I think we often see some founders that are so concerned about optimizing for valuation when they raise, like they're looking for the highest term sheet.
Oh, yeah.
And I think they can lose sight of what it means to partner with somebody. Like this is somebody that's going to be not just a name on your cap table, like they're going to be with you on a journey that will not only have ups, but it's going to have downs. And so who do you want to be there with you, like rolling up their sleeves and helping you along the way? And that is, it comes down to relationship and trust, to your point. So I think that's something that I would probably advise founders not to only optimize for valuation. Of course, it has to make sense economically for you and the rest of the shareholders, but think about like the relationship and who you're choosing to partner with as well.
100%. I agree with you on that. Now, if we look at not the far future, I stopped asking for the far future, but I mean, at least in the coming 1, 2 year, with everything is happening in AI, which sectors or themes, you are very bullish on when it comes to, companies that are investable, I would say, when it comes, of course, to your
Yes.
area, growth equity.
There's a ton happening in the market and it's evolving every single day. So I actually think this is one of the most exciting times to be both on the building side, but also the investing side. I think there's a couple areas that we're pretty excited about. One being the concept of historically, PE firms have focused on rolling up services businesses. That has been, a replicable playbook that a lot of private equity firms have executed on. I think now we in the growth equity stage are thinking about, with the introduction of AI, services roll-ups look a lot different. You can now roll up these legacy businesses, slot in AI, and they start to operate more like software businesses and not just like services businesses. And so we're thinking that there's a pretty big opportunity in that segment of the market for these AI native services roll-ups. So that's one area that we're starting to spend time in. Another area that I think is really interesting is vertical AI businesses, and that goes back to the data moat that we were talking about earlier. I think there's always going to be this question of build versus buy, and I think a lot of companies will end up building their own internal tools, but companies that have deep domain expertise in certain verticals, especially ones that have, historically been pretty offline, I think there's a potential for them to build these very impressive domain-specific vertical AI businesses that will end up being massive opportunities as well. And then the last segment of the market that I think there's going to be some interesting opportunities starting to emerge, and we're already seeing evidence of this already, is in the AI sort of infrastructure space. So what I mean by that is now all of these businesses are creating or buying or rolling out their own agents. And that introduces a whole set of businesses that will have to emerge around how do you monitor the agents? What are the ways in which agents are executing payments, like insurance for agents, security for agents. And so I think there's going to be a lot of opportunities that come forward around creating the infrastructure around managing and allowing these agents to run in secure ways. And so we're continuing to monitor that space. But I mean, there's so much going on. We're just trying to kind of throw ourselves into it and look at everything happening, but it's evolving very quickly.
Indeed, the wave of the agentic AI, as people call it, or the deployment of agents in the vertical way that they are doing it is opening a lot of new opportunities. And I would say not only because you mentioned monitoring, you mentioned payments, and people might think it's only software. Actually, what I started to notice is also like some opportunities coming in the physical world as well because of the AI. Um, I'm lucky because I meet a lot of founders on the podcast, and when they come with the ideas and they say, "Oh, like I never thought like," because now let's say AI, it's like consuming the GPUs like are in the data center, so there's a like whole business of data center optimization now that someone is building it, and there's like the power part of it, and then you have like the cooling part of it. So there are a lot of things which are kind of related to AI somehow and using AI that are also like emerging, and we're gonna see more. But I agree with you, like the infrastructure, whether it's the digital one or the physical one, are like areas to watch, I would say. um as we are almost coming to an end, Isabel, like maybe it's a traditional question, but I still have to ask it anyway. If you want to advise, founders trying to build 100 million plus companies today efficiently, where they should start from day one before they come to you.
I would say to focus on building a business built on strong fundamentals and not just optimizing for headline metrics, because as soon as an investor gets under the hood and sees that, hey, your business has a churn problem, it becomes immediately uninvestable. So I think building a business intentionally, even if it means slower growth at the start, is the way to build a very durable business that will withstand market changes long term. In terms of advice to founders around maybe specifically like fundraising, I would say I would recommend being intentional about why you're raising capital. I think especially during hype cycles like we're in right now, it can feel like everybody's going out to raise capital. Everyone's raising at these big valuations, so I'm going to go out and raise capital. And so I think like being intentional about, hey, should you even raise capital in the first place? Like, do you have a repeatable playbook? Do you know where it's going to go? Is the capital going to accelerate something that's already working, or does your business have holes that you need to focus on first before you go out and try to raise capital? Because fundraising can be a long process. And at the end of the day, if you go out and try to raise a bunch of capital and it takes multiple months and you're not ready, that was multiple months you could have spent building the business. And so I think being thoughtful around should you even go out and raise in the first place is a good place to start.
That's a fantastic answer. Thank you for mentioning this, Isabel, because this is why I tell people a lot. Yeah, this is the first question they should be, asking themselves and trying to answer it. Final thing, Isabel, where people can, learn more and stay in touch.
Definitely. Our Volition Capital's website is volitioncapital.com. We are active on LinkedIn, both the firm and myself, and you can go online and see our portfolio, which should give you a good sense of the types of businesses that we partner with as well.
Great. I will make sure that the links are in the show notes. So for people who are listening on their favorite podcasting app, you will find the links in the show notes. If you're watching this on YouTube, you'll find the description. Isabel, I can't thank you enough for the time. It was a very, great conversation for me also as well to learn about the specific, I would say, area of investment, which is the growth investment. And I think founders will find it beneficial. Other investors will find it beneficial also as well. So thank you very much for sharing your insights today. And this is the way how I end my episodes. This is for the audience. If you just discovered us by luck, thank you for passing by. I hope you enjoyed. If you did so, give me a favor, share it with your friends and colleagues, and subscribe. We're available on all podcasting apps, and we are also on YouTube. And if you are one of the people who keep coming again and again, thank you very much for your loyalty. Thank you for keeping the show since last year, 2025, all the year. We are always in some countries top 200 Apple podcast charts, which is nice. This year you took it like further, and we are like in multiple countries at the same time. So thank you. This cannot happen without people recommending the show and coming and listening. So I really appreciate all the support that you are showing. And as I say always, stay tuned for a new episode very soon. Thank you. Bye bye.
Thank you.